So public service loan forgiveness, the Department of Education says anyone who either works for the government, it can be local government, city or county, it can be state government, it can be federal government, even tribal governments, our Native American neighbors. We just helped someone who's worked for the Chickasaw Nation for the past 30 years, I believe. Or anyone that works for a 501c3 that's tax exempt, that has direct federal loans, will qualify for public service loan forgiveness. As long as that loan isn't in default. Defaulted loans, you lose all federal privileges, you won't qualify for anything. There are only certain plans that qualify for public service loan forgiveness, which we'll speak more about specifically. So there are loan types that do not qualify for public service loan forgiveness. Sometimes it's extremely necessary or it's a requirement that those loans have to first be consolidated before they can qualify for a program. When we say consolidated, what we mean is there are three parties to student loans. There's your servicer, your lender, and your guarantor. The Department of Education is your guarantor. They guarantee your loan. So when you consolidate, the Department of Education will pay off your loan type and they'll open you a new consolidated loan. In most cases, this new consolidated loan, once it's enrolled into the correct plans, can be enrolled into public service loan forgiveness, even if your original loan type did not qualify. So this is a comparison of how your student loans look when you first receive your first bill for student loans. They'll just put you in a standard repayment. It's their default repayment plan. Standard plans are calculated so that they're paid off within 10 years, although they very rarely are. They'll take your loan amount plus how they expect interest to accrue over the course of repayment, and that's how they'll calculate your student loan payments. Your payments are not capped regardless of your income or family size. If you can't afford it, you'll either have to exhaust your forbearances and deferments or go into default. This is versus a plan that qualifies for forgiveness. Public service loan forgiveness is a 10-year program. What you pay is based on what the IRS calls your discretionary income. They calculate this by taking what you make in a year, your adjusted gross income, plus your family size. Is very important that your family size is calculated correctly. The difference between that and 150% of the poverty line in your state. They divide that number by 12. That's your discretionary income. Ideally, the income plans are going to be 10%, but they range from 10 to 20% of that number. You'll see for an average family of 5 making up $55,000 a year, a standard repayment amount for the average amount of student loans is $547 a month. Over the course of repayment, the Department of Education would expect you to pay back $65,640, and this is on average the $30,000 we spoke about that you took out earlier. This is over the course of a 10-year repay. Now, for those who qualify for public service loan forgiveness, the same loan amount, the same repayment period, making the same income with the same family size, as opposed to paying $547 a month. On average, you'll pay $99 a month. You'll see first payment, last payment. The Department of Education calculate these under the belief that you'll receive a 5% cost of living increase every year. But this isn't the 1950s. Nobody gets a 5% raise every year. As long as your income and family size are relatively the same year after year, so will your payment amount. But that same payment period, you would only pay $25,118, a difference in $40,000 over the same period for the same type of loans for the same income. You also will have over $40,000 forgiven over that 10-year period. That's the difference in what the Department of Education sends you by default when you get your student loan bill versus what you could be paying, or I guess I should say wouldn't be paying. So the plans that offer student loan forgiveness, there's only one set of plans. These plans have to be recertified annually. Every year you have to recertify your income and your family size and re-enroll yourself, so to speak, into this plan. If for whatever reason something has changed and this plan doesn't work for you, there are other plans available. But every single year, you have to recertify for the plans that qualify for forgiveness. If you do not, they'll take that payment price away from you. It'll revert back to a standard repayment price, and you may nullify your opportunity to have your loans forgiven. Now, there are loan types that on their own do not qualify for forgiveness. FEFA loans, or the Federal Family Education Loan Program. That's the old student loan program. If you have student loans prior to that were first dispersed before 2010, they're probably FEFA loans. These loans are not held by the Department of Education. Your lender is a private bank. They do not qualify for public service loan forgiveness. They do not qualify for student loan forgiveness. They do not, in most cases, qualify for what the president announced August 24th. They do not qualify for the CARES Act, which put payments on pause and interest rates at zero. Parent Plus loans, they do not qualify for any forgiveness other than possibly what the president announced last week. Perkins loans don't qualify for anything, any type of forgiveness, whether it's public service or what the president announced last week. Direct loans are the loans that qualify for all forms of forgiveness. Now, the first three loan types that do not can be made to qualify. They just don't on their own.
Aaron, we have a bunch of questions for people to ask a little bit more detail about Parent Plus loans. How can they qualify for loan forgiveness?
So Parent Plus loans can be converted into a loan type that qualifies. It's best to have your loans reviewed first. There is a possibility with Parent Plus loans, even FEFA loans as well. If you have other loans, then it's a possibility retroactively you can get credited only under the limited waiver for payments made towards Parent Plus loans. It's a possibility. We would need to review your loans first to see. But Parent Plus loans, like FEFA loans, like Perkins loans, they have to first be converted. They aren't direct loans. Parent Plus loans are. They just don't qualify for forgiveness. Excuse me. Once they're converted into a direct consolidated loan, then they have to be enrolled into the correct plan. There's only Parent Plus loans work a little differently, however. They can only go into one qualifying plan, and that plan, as opposed to being 10% of your discretionary income, is 20%. So sometimes Parent Plus loans, it may not be a good fit depending on how that plan comes back, but it's always better to have those loans reviewed. We want to see what other type of loan types you have. We want to see the projection that your repayment amount will produce for Parent Plus loans. They can be made to qualify.